And good day, and welcome to our November edition of the Economy, Markets, and Investments program, which we are branding it as the E.M.I program for this webinar, which is a series of webinars which we started quite a few months ago. So we'll focus, as I said, on the economy, the markets, and your investment allocations. Right. So, as usual in our style, in the economy, we will look at the world economy first. And just want to put up a slide here, which you've seen before, but just a reminder, because what is puzzling everyone today is why the markets are reacting so strongly, right? So one of the reasons is that pre-COVID, right, the world was actually passing through a lot of trouble. There was trade tensions, tight policy actions in 2018-19, and then in 2019, just before the COVID crisis hit, the world was actually coming back to normal. So there was actually an expectation by World Bank that we would be at 3.5% GDP growth for this March, right? In such a scenario is where the disruption of COVID occurred, right? And so why you need to look at it, this is that in a non-COVID world, the world was well poised to recover. So when COVID comes, as long as you control COVID, you can reasonably expect the world to go back to the old recovery path. That's the one of the key thought processes. And as you all know, the world put intense lockdowns, India also there. And you have seen that the red color of the lockdown has overall eased to a yellow color across the world, including in India, right? And if you take a broader part of the world too. So what this means is that this is the first signal that the world took very strong reaction to COVID. And as you'll see, they did a number of steps to counter the economic crisis of COVID. But medically, they succeeded in controlling it and they started opening up. And India features here as among those which had the strictest lockdowns, but also a reasonable recovery. So the key here is that why I put out this slide is to tell you that it is this medical success. I know there is talk now that in Europe that there is a revival of the COVID, right? But what you must remember in mind is that a vaccine is also coming along the way. So if there is a vaccine and a cure in a short period of time, you think that we can come out of this crisis very, very quickly. So what else did the world do? They cut rates massively. So today you have the world's weighted average policy rate of the developed markets as 1%, 100 basis points below that which was there in the global financial crisis. So global financial crisis was the previous big crisis when rate cut was adopted as a strategy. We have now gone 1% below that. So you can see how the response this time has been very sharp and strong. In addition, there's unprecedented global stimulus also, note printing, right? So if you look at it here, see August 8, where was the US plus Europe plus Japan plus UK, which are the G4? What is the level of balance sheet and where is the level now? As you can see, there's a huge, almost a 3 times expansion of the balance sheet compared to the previous crisis and compared to just 12 months before, it was hardly any note printing. So the second big astra used by the governments has been to use their central banks to pump in liquidity. So cheap money, plenty of money. And then the governments themselves expanded their fiscal deficits to pump more money into the real economy. As you know, rate cuts and stimulus are a secondary method to revive the economy because somebody is going to borrow, there's plentiful of money, but somebody's actually got to use it. Whereas the fiscal deficit is government actually going and spending right at the economy. So the economic boost actually owes this. And if you see J4 plus China, their fiscal deficit expanded to 13% of GDP. And that is a change of 620 basis points. So if you look at it, the governments also used global stimulus through business loans and grants, which have a multiplier effect, as you know, right? And they used job retention schemes because it is a supply side problem. So if you now look at the 2020, this year and next year, America is expected to have a 25% fiscal deficit this year and a 14% fiscal deficit next year. The same is true of all major countries, and India also. We expect to have about 10% in this year as a fiscal deficit, and next year about 9.5%. Now, spending all of this money, rate cuts, expenditure, why is there this expectation that it will succeed? Because in the US, and this is from the previous crisis, we are talking about the year 2007 to 10, when the global financial crisis. As you can see, there is a yellow line and a blue line. So, what is the yellow line? It's the unemployment rate. And what is the blue line? It is the recovery of consumption. So, can you see in the previous crisis, despite unemployment not falling, that is a still high unemployment, consumption started recovering. Very puzzling, right? Normally you will think that people will go to work and then they'll consume. But it's the funny thing that the lower end, which counts up the numbers of employed people, are not really the consumption spenders. It is the higher end bracket people who are spending. And you see that even before unemployment started dropping, consumption started rising. So this is one of the key anchors. Is of course you use the US as an example to tell you that don't worry that if unemployment is not coming down, consumption can still go up because of the higher income people going out and spending, right? So similarly, right, if you look at the expectation of a V-shaped recovery now, just go back to 2008. American household debt was 97% of GDP. So almost every household had borrowed to the hilt. Now American household debt is only 74% of GDP, which means individuals can borrow another 25% of what they've already borrowed to reach the levels of that time. So there is enough spending capacity available in the US economy to boost the consumption recovery, right? And as a result of this, action is already being seen. As you can see here, this is the PMI. The PMI is a very good indicator of future GDP growth. And you can see China was the first to show a V-shaped recovery, but has flattened. But Europe and US, though they followed a few months later, because the crisis hit developed countries a few months after they hit China, their recovery path is on a very strong wicket. You can clearly see the V-shape forming here, right? So overall global, if you see, you match the output to the new orders, there's a clearly a V-shaped rise. And China specifically, because since China got the crisis earlier, is recovering earlier, it gives you a sense of how the other countries can follow. So a couple of slides on China to tell you that a daily average passenger car sales, which is a consumption indicator, and heavy truck sales, which is a freight indicator, both have shown a V-shaped recovery. And if you take the services PMI or the manufacturing PMI, all of them have shown a nice V-shaped recovery in China. So that's why it augurs well that the world will soon follow, right? And actually, month on month, 83% of the world's economies have seen their PMIs expand October over September, except Russia, Indonesia, and Japan. So most of the PMIs, they have the headline PMI is high and the new orders are high. These are the statistics. And in the US, just look at the yellow line is 2019. The green line is 2014 to 18 and the blue line is 2020. Can you see that US existing home sales, that is second-hand sales of house, has jumped well above the historic levels, right? And global trade indicators reflect a V-shaped return to growth. In fact, I'll demonstrate it through the Baltic Freight Index, which pre-crisis was at a 1090 level. In the crisis fell to 626. Today it has doubled to 1148. So global trade is also on a path of recovery, and hence IMF has revised the global growth forecast upward by 80 basis points to 4.4% in 2020. So you can see that the V-shaped recovery there, and hence effectively all COVID has done is pushed back global growth by a year. That's what this graph is telling. So the world is poised for a going back to the pre-COVID days in the very next year itself. That's why the stock markets are anticipating this and rising. So let's turn our focus to our domestic economy, right? In domestic economy, again, we are using the tagline and giving away the answer that we are also riding the recovery wave, right? What did we do? We did the Atmanirbhar program, which is about 10.5% of GDP. Some of it as guarantees, some of it as RBI liquidity measures. And overall, In October, the government topped it up with 73,000 crores of fresh measures, almost 0.5% of GDP. And in November, pre-Diwali, government announced another 2.7 trillion rupees, that is 1.5% of GDP. So 10.5 plus zero point 0.4, 10.9 plus 1.3, almost 12.3% of GDP. The government has in some form maximized the impact. They've also used the opportunity, keep this in mind, that not only have they done these things at the individual person level to help the companies and all of that, they've also pushed in long-term structural reforms. And these are very, very critical because these are the main reason that FII money is flowing into India. So as I've said here, India has chosen not to waste the crisis and they've upped the ante on the reforms front. So what are the reforms they've done? Essential Commodities Act, APMC reforms, commercial coal mining, domestic defense production through FDI, privatization of union territory power discoms, then states will follow. Public sector reforms, they've opened up pretty much the whole of the public sector to private sector, and RBI's resolution framework. We'll delve a little more in detail on RBI. But overall, if you see, at about 12% of GDP, 10.5 plus those other measures, the fiscal deficit impact has been contained. So apart from reforms, this is an important factor on how much all of this is going to hit the fiscal deficit, and that's only 0.8%. How did the government achieve? Partly by doing guarantees, partly by firing from the shoulder of RBI, and partly because the crude price drop gave us a huge inflow. How? Government hiked the excess duty on crude. So almost 1.7 lakh crore, which is 0.8% of GDP, they got additional income due to the crude price drop. So that has also helped them to ease the fiscal burden, right? This is how it actually pans out. Every $10 drop in price brings down India's current account deficit by 0.5% of GDP. So as a result, in March this year, we actually turned positive on our current account deficit, and this has its spillover on rupee stability. So now when you look at the rupee long term has to depreciate at 5% because the US 10-year is at 5.9, sorry, 0.685, and the Indian 10-year is at 5.9. The difference in interest rate tells you at what rate the rupee should depreciate. And if you see 10-year, 5-year, it has been around that 5% mark. But this year, 1 year, it is only weakened by 3.32. In fact, 6 months, if you take since the crisis, it's actually appreciated. So all of this is a positive for India because it brings down the cost of our imports and encourages FII flows. Right? I spoke about RBI doing something. A lot of the things you would have seen in the various credit policies. So essentially, RBI has done a pre-Atmanirbhar 75 basis points, post-Atmanirbhar 40, totally 115 basis points, cut in repo rate to make it reverse repo to make it unattractive for banks to put in, and a whole host of other measures which are listed here. And they announced a resolution framework instead of a third moratorium. Two moratoriums they did, 3 months and 2 months. And then instead of a third moratorium, they brought in a resolution framework saying no more moratorium, but let's restructure the loan itself to a 2-year, 3-year tenor. This is the guiding principles. And Mr. Kamath, appointed as a committee, submitted his recommendation, and that framework is likely to benefit 66% of rated companies in India. So across 26 key sectors, which are the main sectors benefiting? Construction, real estate, and chemicals are the key beneficiaries. And now we'll move to all these Atmanirbhar plus RBI plus all these measures. Are they affecting the economic indicators on the ground level? So first good news is that government's income, GST, has shown a 10% growth month on month and is now reached back to the 1 lakh crore, which it was clocking pre the crisis. So that's good news. Second, in the states also, if you see, there are some states which have shown 22% growth in GST revenues, Rajasthan, Odisha, Haryana. There are some which are laggards like Delhi and Karnataka, Maharashtra. So overall India, as we said, it's a 11% growth, right? And there are other short frequency indicators, which are exports, the blue line, yellow line, two-wheeler sales, purple line is power demand, gray line was GST, which we already saw, light blue is the passenger vehicle recovery, and green is the railway freight recovery. As you can see, all of them are forming a very sharp V-shaped bounce back, right? Other indicators like the e-way bill, which government uses to make purchases. Not only is there a V shape, it has gone from negative growth to positive growth, right? Manufacturing PMI and services PMI after deep contraction have now come up, and apart from the V have crossed 50, which indicates that we are coming out of the recessionary phenomenon, right? Electronic toll collection on highways as lockdown opens up. As you can see, a V-shaped recovery there. Electricity consumption showing a rising trend. TV ads, yes, with the lockdown and the IPL happening, naturally TV ads have shown a sharp rise, right? And the freight. Now, what are the heavy freight items that get carried? Cement, steel, coal, fertilizers, right? So each one of them, if you see, you can experiencing a V-shaped recovery. And in fact, a couple of things down, steel has grown 118%, coal 110%, fertilizer 111%, and cement at 119%. So there's an appreciable recovery across multiple sectors. So overall total freight is also showing a V-shaped recovery, right? So overall unemployment is a key indicator. You're saying there's an inverted V there, which means that unemployment is dropping and almost reached the pre-COVID level, whether it's in rural India or in urban India. And so overall, to bring the economic activity together, Jeffries publishes an economic activity indicator, which is telling you today that we have reached 97% of the pre-COVID level in terms of economic activity. So India in the world is among those showing a very, very sharp recovery after that first quarter's minus 24% GDP growth, right? And what is driving this recovery is the agriculture sector, because Kharif sowing as a percentage of normal area right from June has been steadily rising. In fact, today we are at 25th September last data at a high of a decadal high in terms of normal area sown. So clearly agriculture. So when this harvest will come, it will come out in December, January, around the Baisakhi, Pongal, those kind of a thing. So as a result, if you look at it, housing and real estate are well set for a turnaround. So this is just Mumbai suburbs as an example, right? 2007, 2012, 2017, and the current rate. Price per square foot from 7,000, it has actually doubled to 13,500, right? But what I'd like to draw your attention to is that the stamp duty cut, which the government did in Maharashtra, right, to 2%, has seen a surge in residential real estate demand. So look at this, what I've highlighted in yellow down below. The E.M.I to income ratio, because of these factors, has actually come down from 51% to 29%, right? And if you look at the property price to income ratio, it has come down from 6.3 times your income to only 4.2 times. So can you see the revival in the housing sector is happening? Yes, bear in mind that a lot of these are second-hand house sales, right? So new creation of real estate will take some time, but this is indicating on the consumption side that dropping in interest rates as well as the incomes generally being trending up has led to a much more affordability on the housing sector, which augurs well for the economy, right? So this is the same thing. It shows you that the tax adjusted interest rate and rental differential yields, right? So there you can see that spread, right? In 2012, it was 7%. The difference between a post-tax interest and the rental yield was 7%. Today, it has come down to less than half of only 3%, right? So somebody borrows to take a house and then gives it on rent. 3% is the net cost which he is doing to acquire a long-term real estate asset class, right? So it's been at a very, very, very marginal cost now compared to just a few years before, right? So as a result of all of this, one of the important things for us to ban, as you know, 1st February, the budget is coming up, is what is our rating likely to be? And the way we manage the crisis. We've made big announcements, but less expenditure. We've got crude coming to our support, and we have introduced reforms in this whole Atmanirbhar program, because of which whatever downgrade in terms of rating watch and all of that outlook has happened, and we don't expect a big downgrade. So India should continue to retain its investment grade status, right? With that in mind, right? Let's turn our eyes to the crisis itself, the COVID crisis, right? India infection curve peaked in September, right? The daily new cases and the daily new case 7-day average clearly showed. But from that 20th September peak, we have now got control over the cases and it's coming down. I know there are 4 states where it's peaking, but overall as a nation, we have managed to control it much better in the world. And if you see the increase in fatality rate and the recovery rate, the fatality rate is dropping and the recovery rate is rising. In fact, in terms of the world, if you read what's in the paragraph on the right, right, India, because of our population, we have the second highest number of COVID cases in the world. But you measure against deaths per million, we are at 89th rank, and US is at 715 and France at 573. Right. So to summarize the whole GDP economic exercise, we had a 24% negative GDP growth in the April, May, June quarter. This quarter, that is the September quarter, we expect it to be 9%. And now the quarter we are in, we expect it to be marginally negative at about 1.7. And thanks to the Kharif crop and the agricultural harvest, we expect that JFM, the last quarter of the financial year, for the quarter, which should actually be 2% positive GDP. So the V-shaped clearly. So this is what the markets are looking at. But, right, I want to take a diversion to repeat something that I've done in the past, that shorter term, yes, we are looking at a V-shaped outlook and we are looking at a 2% quarterly GDP. But if you take a medium term outlook, the V shape is likely to get even stronger because we have a lot of structural positives in place. Right? The first thing is that we've cut tax rates to half of what they were. The second is our ease of doing business ranking continues to improve. We've improved by 79 ranks. As a result of which, gross FDI flows into India are at an all-time high. Why I'm saying this FDI is going to be the booster of our economic growth because new factories, new things come. Where will they come from? They will come from relocation from China. So as you can see, post the COVID crisis, 44% of companies who were manufacturing in China say they have increased their intention to relocate, and the intent to set up new facilities outside China has also gone up. So this augurs well for the infrastructure and the capex cycle of our economy. And one of the main reasons rising is this: China's population is on a decline. Our working age population is on a rise for the next 30 years. So plentiful supply of labor and very positive fiscal. You saw in the reforms also there was a lot of FDI positive in defense and other sectors. So overall, India is structurally set for a huge consumption and manufacturing boost. So with that positive medium-term outlook and a V-shaped recovery, the markets, right? If you look at the actual earnings growth of the Nifty, right? While it's still negative, it is quarter for the quarter, it is less negative than the previous quarter as of the September quarter, right? And when you analyze the earnings, it's important to look at the earnings in the comparison to what the analyst expects, and analysts then upgrade their earnings. So if you look at it, the key sectors of the economy, right? Demand, which is consumption, infra, cement, industrials, and global price takers like steel, where the price is driven by London Metal Exchange prices. Then you have financials and you have exporters, right? So now when you look at the number of companies, there's about 94 companies which reported. The consensus estimate for FY21 and the estimate for FY22. How have the analysts changed it? So then when you look at the green, you see that global price takers, financials and exporters are the ones for this year who have seen earnings upgrades, whereas for the next year, this shifts to little bit better for infra cement, which was negative for this year, changes to positive for next year. So exporters and financials continue to be the driver, right? So this earnings consensus going up is one of the main reasons that more money is coming into the market, because the P ratios based on a forward PE has come to becoming reasonable, right? So if you see for financial exporters, the change in the Nifty earnings upgrade, you can see April, May, June, they were all negative, but from July onwards, steadily quarter on quarter, the earnings estimate of the Nifty has been rising, right? And if you look now at the number of companies beating Morgan Stanley's analyst estimate, right? Now, when you go, it's from right to left. So fourth quarter last year, 2019, quarter on quarter, as you can see, when you go to green, it means it was better than the previous, strongly better. Light green means slightly better, red means worse. So except if you now turn your attention to the first column, which is second quarter FY21, right? Energy is 25% compared to last quarter was 57%. So it's down, right? That's energy. But materials is 100%, utilities is 100%, and healthcare is 86%. So as you can see, the earnings, and so overall Sensex net profit growth has been 12% above the analyst estimate. That's how you get a price uptick happening, right? So as a result of this, the Nifty EPS trend has been enhanced from 477 for this year to 664 for next year. So any FI buying even with a 1 year outlook is going to see that there's almost a 50% rise in the earnings growth expectation, right? So as a result, now from a valuation perspective, the Nifty, the mid cap, and the small cap index, all of them have seen a bounce back in valuation, right? Going past their long term average to slightly higher. To look at it in actual numbers, the December 2017 peak, the Nifty was at 18 PE, today is 18.4. So there's an improvement in valuation by 0.6. Mid cap was at 24, is currently at 15. So clearly still way off from the historically high valuation, and small cap is also way off from a 20 which was there in December to 15. So as you can see, the large cap has gone past its December 17 peak, but the mid and small cap still has room to go. So if you see down there, the mid cap index is still trading at a 16% discount, as is the BSE small cap to the Nifty, right? So another way to look at this data is to take the difference between the GSEC yield and the Nifty earnings yield. Nifty earnings yield is nothing but 1 divided by PE. So the PE is 20, earning yield is 5. So the difference between the GSEC and this tells you which asset class is giving you more return, right? And that gives you a trigger for a bull run in the market, and that's what has happened. As you can see, the move upward, right? That difference is actually driving your valuations upwards, right? So as a result of this, so the one way to look at this is to look at in terms of cycles, right? So we know that our economy has been through various cycles. 2003 to 8 was a bullish cycle, 8 to 13 was a bearish cycle, again 13 to 17 was a bullish cycle, and then again we saw a bearish cycle, and then from March 20 this recovery. There are two ways of looking at it, saying it's a part of the old bearish cycle or there's a new bull cycle opening. So if you treat it as a new bull cycle, you will see that in the new bull phase, the Sensex, mid cap, and the small cap all have risen 50%. But in a true bull scenario, right, the mid and small cap should outpace the Sensex. So that will be the test of whether a true bull run has started, but at least the initial indicators are showing that, right? So when you look at institutional flows, right, on the back of valuations and the earnings growth, flows have been coming into India. So the left you have domestic mutual funds, the right you have FII. The graph may be difficult to understand, so I've captured it in numbers here. So from April onwards, right, you take quarter two, which is April, May, June, quarter three, which is July, August, September, and quarter four. FIIs consistently have been almost doubling their flows every quarter. From 30,000 crores in quarter, there's a 50% jump to 46,000 crores in the next quarter, and another 50% jump to 68,000 crores. So overall, since the beginning of the financial year, that is post the March correction, FIIs have pumped in 1.44 lakh crores into India. right? And at the same time, mutual funds have actually pulled out 50,000 crores. Now, the thought processes behind the FII fund manager, what is the reason? I told you the TINA factor. That is, there is no alternative from that perspective to whatever growth India is showing, they preferentially have favored it. But domestic MF, because they can see the near term challenges, right? And the fact that they've been facing redemptions overall, except for the first 2 months, they've been facing redemptions. They have been net sellers in the market. That being said, they all hold reasonable cash going forward to buy. But today, you can see the rally in the large caps is almost entirely driven by FII flows, as the data starkly shows you, right? And so, FII's experience of investing in the emerging markets and other markets. 2019, India, they got only 8% return because our economy was going through a slowdown. The stock markets reflected that. This year, what has happened? They're still negative on returns from the Indian market, right? Whereas it's the US market, the Nasdaq is up 21% and China is up 20%, right? So if, despite all this money going in, FI still haven't seen the kind of returns from the calendar year. Part of the reason is that there was a March correction and then a recovery, right? So this is return from January to October, right? When you come then to valuations, right? You look at India's valuations compared to the emerging market, which is the bottom line, the and the world market, which is the top line. So if you can see, sorry, I've said it opposite. I think the bottom line is the world market and the top line is the emerging market. India has always traded at a premium that went through a correction in the period of March when India corrected more. That led to a valuation gap in the historical long-term premium, and hence the bounce back, as you can see in F flows, has resulted in the valuations for India again creeping back to a strong premium. And overall, emerging markets have suffered relative to US because it's the S&P 500 whose valuations are very high, followed by Europe and by Japan topics, and then by the emerging markets, right? So from an India specific, right, as an outsider looking to India, the MSCI index is what they follow. On the left hand side is the P ratio. On the right hand side is the price to book ratio. So that's another interesting tracker for all of you to track, because India is definitely looking expensive when you look at it in a price to earnings ratio on the left, right? It's the black line in the middle is the long-term average P ratio. And clearly you can see that India is trading well above its long-term average. But when you come to price to book, India is trading below its long-term average. What is the reason? Because capacity utilization in the country has dropped. So the book value and the earnings, right? When you then compare the price to the book value, clearly we are trading below. So what does this mean? It means for the Indian economy to come back to the earnings stream, right? The market is saying they don't need to get fresh capex. They don't need to do fresh capacity to do anything to borrow. So there is a chance of easily coming back. So the undervaluation of India in an FII's eyes comes from the price to book value. And as you can see, it's not just the MSCI India index, which is a large cap index. You take the MSCI India mid cap index. The P ratio is well above, but the price to book is well below. Take the small cap index. The P ratio is well above. The price to book value is just about. So small caps have risen in valuation, right? Right there, slightly above their long-term average. So from that point of view, to summarize, let's look at the performance. Let's look first at the sectoral performance. Why do I look at sectors? Because it is sectors which drive cap curve. It is sectors which drive stock prices. Fund managers choose sectors first, and so that gives you a clue as to what fund managers are buying. Then they choose good quality stocks from large cap, mid cap, or small cap. So now I've ordered this from top to bottom from a safety versus riskiness sectors. So take BankX. Historically, BankX is perceived to be a safe sector. IT and tech are safe. Pharma is safe. Consumption, the discretionary consumption, FMCG is considered safe, but auto and consumer durables are slightly riskier, and cyclical and industrials are definitely riskier. So you can see the change in the market. Right? Take the 3-year returns. They are showing green for most of the safety sectors, but come to the cyclical industrial, India's long-term slowdown, further accentuated by COVID, means that 3-year returns of all the risky sectors are negative, right? Just come to 1 month return and 3-month return. Can you see how the favor is now shifting towards the cyclical and industrials? Because if you take banking now, because it got hammered in the COVID crisis, because of the fear of NPA, has become a cyclical sector in the short run, because they are the ones who are going to finance this cyclical industrial recession. So if you now look at it, the safety, which is your IT, tech, pharma, FMCG, are all in the low to middle single digit, whereas Bankex, capital goods, power, metal, all of them are in strong double digits. So there is a change in leadership happening from safety to risk. If you, those of you who track me, like 18 now, I had actually said there's an handover happening from safety to risk, which is what is reflecting in the valuations. Now, keeping these sectors which are doing well in the say 3 months, 6 months period, now when you look at it, right, at the Nifty, which is the dominant factor of the Nifty, banks are 25%, software is 17%. So 25 to 17, 42%. So what is done well? Pharma over a longer period has done well, but it's 6 months plus, but over the shorter period, pharma has not been doing so well. Correct? 2%, just positive, but only 2%. Same with the Bankex, right? So now when you look at the Nifty, remember, bank plus software dominates the Nifty. In fact, you take bank plus finance and software, that dominates the Nifty. Petroleum, as you know, is one particular stock. Whereas, go to the mid cap, yes, finance and banks continue to be, but as opposed to it's only 22%, whereas here it is 24 plus 11, 35%. So the weightage of banks and finance in the mid cap index is less. What has replaced it? Pharma. So the performance of pharma gives a boost to the mid cap index, because in the large cap index, pharma is only 3% of the index. So while FIs are putting money and this, I will come and end with your, Sensex versus mid cap index, how they are performing. But just remember that the sectoral weightages drives that index performance, right? So now we move to the small cap index. Pharma is dominating it. Pharma is 15%, then it's finance, then it's software. So these sectoral mix of the index drives the performance of those, because when you look at the multi-cap indices, like a BSE 200, it's 89% large cap. When you look at the BSE 500, it's 81% large cap. And even the NSE 500 is 81% large cap. So we may say a broader market, but still they are dominated by large cap stocks. So as a result, now when you look at the performance of the Sensex, you'll see that same safety versus risk play out here. 3-year returns, the safer Sensex and Nifty are the outperformers, but your mid cap and small cap indices are in negative territory. Whereas in the 1 month and the 3 month, you can see that the leadership has shifted to mid cap, right? It's much more flatter. So this reason for this is the sectoral performance. Why I'm saying this, when you then translate this into mutual fund performance, you realize these are the factors at play. And that's why when you see on a 6-month basis, small cap index seems to have performed 54%, then follows the mid cap at 48%, then follows the large cap at 40%. So to summarize, the large caps are driven by FII flows and the safety oriented sectors. The mid caps and small caps are driven more by the only common feature is pharma, right? Otherwise, is the in the small cap index, as you can see, the industrials, chemicals, or construction, cement, all of those are fairly segment. Banks are only 3% of the small cap index, right? So with that, let me summarize my thought processes for this evening by saying that the disruption of the pandemic is well behind us. The large monetary and fiscal stimulus is working its way through. Now there is certainty around the US elections with a Biden win. That's positive for world trade and continued global monetary fiscal actions, which will remain supportive for India. Activity in agriculture and rural India has remained strong and relatively unaffected by the pandemic, aided by the government's spending focus. Price realizations are improving with increased MSP support. So rural spends are increasing and agri reforms add support to rural India. The RBI has been preemptive that is proactive all along, and its liquidity engine, clumped with the resolution framework, are set to greatly aid the ongoing recovery. Right? So the government has been redirecting its fiscal deficit in form of packages to push consumption on the ground, accelerating the pace of normalization. But it must be noted that a successful recovery itself would ease the stress buildup in the banking system. So, with India's inflation curve clearly having peaked, vaccine approval will work to hedge any downside risks, right? And this is supported by low corporate tax rates, low interest rates, plentiful liquidity, rekindling of reforms, and ease of doing business improving, right? Tactically, the government is using PLI schemes and the focus to be China plus one to continue attracting FDI flows. So emerging market Asia is set to attract a sizable part of the global quantitative easing liquidity on the back of its better COVID handling, lower debt ratios, benefit of lower crude prices, and a healthier balance of payments, right? So from that point of view, at Sundaram, we share a view of tempered optimism, right? Which is to say that the COVID is well behind us. V-shaped recovery appears evident. Macro data, company earnings, and realizations are all beating their estimates. And with global economic recovery underway, the RBI's actions and the employment coming back to pre-COVID levels helps ease the system stress, right? So we expect upward revisions to India growth on the back of the above consensus activity pickup. Rural India and the middle income urbanite will remain the segments of strength, right? India has always reformed and turned around during a crisis, and COVID has given Indian manufacturing this very opportunity through the growing global de-risking shift to a China plus one. Global liquidity is yet to peak and set to push investors into assets with higher risk premium like emerging. So India remains in focus among the pack with continuing earning surprises and a growth cycle ahead, which is yet to be priced in. So we remain bullish. So as a result, our portfolio across our funds are poised for a domestic growth recovery, right? Increasing exposure to quality financials, consumer discretionary, building materials, and auto. That's the themes we are running. And within the financials, we have a bias towards large, well-run private banks and good quality NBFCs. The global recovery, we believe, can be played through materials like agrochem, specialty chemicals, auto ancillaries, and IT services. We continue to remain relatively positive in defenses like FMCG, pharma, telecom, but very selectively stock picking here. We have moved closer to sector neutral positions, giving us enough room to play the small cap, mid cap, large cap, cap curve, and within sectors to choose companies, right? That's the way we would try to deliver alpha. This portfolio positioning will keep us nimble footed around the key risk, which is the second wave of COVID coming to India. So that's the one risk we have to be careful about. We are pricing in the evolving situation on the ground in our numbers, and we continue to scout for good and sustainable business at fair valuations, right? Our portfolio continues to be capturing reasonable stocks with a growth-oriented focus. So thank you very, very much for patient listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.